The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Welcome to How to Money with Cole and Cole.
I'm Cole.
And I'm Cole.
We coach people every day on their money and how to plan for the future.
As financial advisors, we're here to have an honest conversation on investing, retirement, and everything in between.
At Full Swing Financial Planning, we're here to empower you to take control of your plan, your way, for your financial future.
So let's talk money.
And sports.
Welcome back to How to Money with Cole and Cole. I am Bailey Ashbrook, and Cole Jaskie's to my left, and there's a lot of snow out there, and I hate it.
Yeah, it's this makes it tough when it just
That was
snows early
like
December.
15 inches?
15 inches out, over a foot, right? When it snows in early December, in this case started in November, and we're probably going to have snow.
It's terrible. I got to book another trip to Arizona.
Oh, yeah, I know. I was like, I've been driving around every day. I'm like, where am I going next? To go south to get out of here. So,
but I cannot believe it's December. Christmas is upon us. A lot going on. I want to say this. We have been kind of thinking about podcast feedback, and we've been listening to people's feedback, and we're just going to chum out the sports talk because I feel like people are here for the financial content, and that's what we want to provide.
We're going to get down to the content. Quicker.
And I also want to mention Cole J has been a podcast star recently, and you should go check him out. You were on Talk with Fort Dodge.
Yep, Talk Fort Dodge.
And Spin Market.
Yep, the Market Report.
Those will both be released, Peter, soon?
In December sometime.
Yes, yeah. So check those out. I also was on Active Health Clinics. I don't think that's not out yet.
Gosh, we've been I know.
So I just want to shout out to all those podcasts for having us because we have people, but it was fun to go on other ones.
It is always fun to just show up and even though that's what I do all the time, you do all the work. You and Peter do all the work. So, but it's nice just they give you a few.
You're the star of the show.
Yeah, right.
But yeah.
Yeah, someone's got to sit around and look good, Cole.
Yeah. Thank you.
Yeah, but check those out.
So I told my wife at home, right?
Yeah, she's done.
I'm supposed to sit on the couch, right?
Okay. Get back on the rails. But last episode, we talked about 401k strategies because it's the end of year. It's kind of the theme, and that's what we're going to do today. We're going to do another year-end tax strategy. But before that, we're going to get, like I said, more into the financial nitty-gritty, but make sure you like, subscribe, share, look at the 401k podcast last episode. It's really beneficial, but we'll get right into this and do some 2025 year-end tax strategies and such.
Year-end checklist for us.
Yeah. So let's get right in. This is an important window for tax planning because it's the end of the year. Tax brackets are locked in. You can make smart, proactive moves, and that's what we're here, and that's why we want you to do that. So number one, I love this. This is making me excited. Roth conversions, why they matter at the year end, Cole J.
Yeah, let's start, I guess, first and foremost. One, they got to be done by the end of the year. So a lot of the stuff that we're talking has got to be done by 12/31 or wherever you have your
Deadlines.
assets, your assets held at. There's probably some processing date that you have to have things done by. But let's start, first and foremost with, historically, we're still in relatively lower tax rates. I know that's hard for people to believe, and that's probably one thing that everyone has commonality of. Everyone would like to pay less taxes, I think.
We were just talking about this off here. Everyone wants to avoid taxes and all these penalties. And
it's really comes down to, if we can pay less taxes and net more in your retirement accounts,
Absolutely.
right? Or be, a better setup in the long term.
If you're going to be in a higher tax bracket later. Yeah.
And it's sometimes you're making some of these decisions that we're going to talk about today is maybe they hurt a little bit more now, but long term they look way more beneficial and it can have a very substantial impact on your long term financial plan.
So why would someone, and your income is kind of finalized at this point. You know what you're going to get. Why and how to do a Roth conversion, Cole?
Yeah. So let's just use an example of I've got $1 million in a pre-tax traditional IRA, right? And I'm looking. Hey, I don't have any, every dollar that comes out of that account when I retire, whenever that might be, is going to be subject to income tax. And depending on what state you live in, could be, state and federal income tax. But we at least know across the board, it's going to be federally taxable. So what a conversion is taking a portion of that, you're going to pay the tax now. and you're going to convert it to a Roth IRA, and then you could still invest it, keep the same investing, and hopefully have continued growth, and anything that grows to, when you decide to use it, comes out then tax-free. And really that's when we're relaying this back to a financial plan or a retirement plan, it's tax diversification, right? Now, we don't know what tax rates, especially if you're, say you're 50 and you're like, hey, I've got 15 years, I'm going to retire at 65. We don't know what tax rates are going to be 15 years from now.
We think they'll probably be higher. We don't know. It's always on Congress.
If you look at, you look at the debt cycle and where we're at, to pay for things, most likely the easiest way for the government to pay for things is going to be to hike, income tax rates, right? So that's probably going to be a string at some point gets pulled. But when you look, 15 years into retirement and you're looking at that and like, well, if all my income is subject to taxation,
and then you have Social Security and then
pensions,
you have pensions,
whatever you might,
it starts to really add up.
Yep. Versus if you have, that Roth bucket that's growing, that gives you the ability, hey, at some point that if I need a larger lump sum dollar amount, or I just want to start taking some, income stream and I want it to not be subject to taxation, having that diversification, having that Roth bucket can be powerful. And a lot of times what we're doing right now is we maybe have a 5-10 year strategy with a client, or, we do this for a lot of our clients, but we're saying, hey, we're not going to do it all now, but we're going to take X amount each year, in December 15th, and we're going to convert it to the Roth.
And this is what you'll pay in taxes. And do you want to take, go into the marshmallow theory, because I know I've made you tell us on the story. I truly think this aligns. Yeah,
it's very, this is, again, it's one of those, you're making a decision right now that's for the future.
Delayed gratification.
Yeah, delayed gratification.
Everyone wants the deduction now. Everyone wants to lower, but what we're saying is if you have the funds to pay the taxes now, let's pay the tax now, not get the upfront deduction, but it's going to grow tax-free, and you're going to have that flexibility and planning power in retirement with that bucket.
And you can withhold the tax from your conversion amount. So that's the nice thing, is not like you have to write a check in.
Correct.
You can elect, like when we're doing it,
account.
We'll go through and say, hey, okay, we're converting $10,000. We did an analysis of your taxes, and it turns out you're going to owe $500 extra in state, $1,500 extra in federal. We can have that withheld, and then that $8,000 gets converted.
Correct.
And we continue to grow it within that Roth IRA. So it's one of those things that, yes, sometimes is painful now. But again, looking long-term, and you start to look, hey, what is the power of that tax-free growth? Because now I no longer have to worry about, hey, hopefully that grows to $10 million, because it's all tax-free from there on out.
And let's get into this. You don't have to take RMDs out of your Roth. So go into that. For the listeners, just quick, what is an RMD and the power of not having to take one? Yeah.
And if you're someone that has, majority of your retirement assets or majority of your wealth is in pre-tax accounts,
which I feel like we have a lot of clients, because Roth is definitely,
it's still relatively new. It's still relatively new. I think 1996 is
I would say our retirement, they're like, oh, I wish I would have done some Roth conversions, or they're really interested in it now, like in their 60s right now. They're like, oh, I wish I would have put some more in Roth, because it wasn't, again, a thing. But
one of the most powerful things I've found in my experience with people when they do have Roth buckets or they don't, is when they have a larger purchase that they want to make later in life, but all their money is in qualified accounts or pre-tax accounts, and they're like,
bumps their income.
Yeah, they're like, oh my gosh, if I take $250,000 out, that my effective tax rate goes through the roof for that 1 year. And a lot of times it'll hinder them from doing that, or they might take on debt instead of doing that just because of the taxes, versus you have that $250,000 in a Roth.
You want a boat.
You do not.
Go get that boat.
You do not have to worry about that. But let's talk about RMDs.
Yes.
Right?
So we got off the rails.
I know, but it's very relevant to the situation. But if you're that same $1 million example where all pre-tax, you get to age 73 now is the age you have to take out what's called the required minimum distribution. So, and what that says is the IRS says, hey, you got a pre-tax deduction on this money all along the way. You contributed through your 401k or your traditional IRA. Now, when you get to age 73, we want you to start claiming some of that as income.
We want you to pay that tax.
We want you to start paying the tax bill. And they give you a dollar amount. Basically, what happens every December 31st, there's a chart the IRS puts out on life expectancy, and there's a factor number. You take your December 31st balance divided by that factor. That is the required minimum distribution amount you have to take out for the following year. So in theory, if you have, $1 million, $2, $3, $4 million, you might be forced to take.
We have some large RMDs.
I have some people that it's drastic. You start to look at growth and what they're going to have in RMDs, and they're like, well, that's double the amount of income that I'm going to need.
And they don't need the money.
so you're just paying more taxes, right? So that's where, if you're one of those people that don't have a lot of tax diversification, but you've saved a lot in pre-tax, great. But let's start looking at that Roth strategy or the Roth conversion strategy.
And the reason is too, Roth is not considered income in retirement. So if you're taking those larger amounts, your income's not. So IRMA, Social Security, all those things that are affected by your tax bracket, Medicare payments, all these things, Roth income is not considered income. So if you do want a larger purchase or you want that flexibility, it doesn't bump all that up. So again, no RMDs. Cole knows this. Roth is like my favorite word.
And it's one that you don't, I mean, it's nice to get a lot in there up front. Because the one nice thing about a conversion is you can do a very substantial amount. Now you just got to know what the tax bill is going to be, right? Versus doing a contribution, you're subject to the annual contribution limits, all the different rules the IRS has based on income, and which right now is $7,000 for you or I. That's all we could put in a Roth. Versus, hey, I could do 100 if I had the money in a pre-tax account. I could, in theory, convert the whole account. I just have to claim that as earned income or as income that's going to have taxation subject to it.
But again, the tax brackets are locked in. So this is the time to look like, hey, should I convert this amount now? And then what will that be in 10, 20 years and not having to pay taxes? So those are things we help sit down and plan with and go over the numbers.
Definitely cleaner for heirs too.
Yes.
This is one thing.
If it's important for you to leave money.
I have some people, it's so funny when I ask this because some people are like, I don't care.
Yeah. And some people very much
so
care.
concerned about it. Right. So this is very individualized to your situation. But if you're looking at your, your accounts, you're like, hey, what's the most efficient account to pass to heirs? One of the top ones is definitely a Roth IRA. The money passes tax free. They'd be subject to different rules and things of such there, but ultimately, very, very powerful, easy for someone to inherit.
So they switched this back in the day. So let's say I inherit money from my parent or whoever, and it's all pre-tax. I have 10 years. I have to take all that money out. And that means I have to pay that tax bill. So if it's a large chunk of pre-tax money and I have to withdraw that within 10 years, and you'll see, this is why we're talking about this, the tax brackets really matter. And this is why passing down tax-free money is important. Yes, do I still have to withdraw that money, but I'm not paying taxes on it and I can go reinvest it and do whatever I want.
Again, another $1 million example. Let's say you have one child and they inherit, you're 75, you've been taking RMDs and you pass away and your one child inherits $1 million. They now have to distribute that $1 million account over the next 10 years. They'll take a little bit out each year and then they're required to have it depleted by year 10. And that is all going to be considered ordinary income to them. So that's going to most likely plus whatever other income they probably have. It's going to be subject to a lot of taxation. So if we could plan a strategy around that and say, hey, let's try to get $300,000-$400,000 in tax free or into Roth over the next 5-10 years. And then the other is pre-tax that, hey, so be it. They got to pay the tax bill. Yes. We can't solve every problem. But if we
can eliminate some of that messy multi-year distributions out of the pre-tax.
If I can tell you, hey, by doing this, your heirs might get an extra $150,000 they net versus paying an extra $150,000 in taxes. Most people be like, oh yeah, let's do that.
And again, that might not be important to you, but again, another benefit of looking into a Roth conversion at the end of the year. Right now, it's just a good time to see where income's at, identify how much space you might have in your tax bracket and convert to that threshold, but it's definitely a very powerful strategy.
Yeah, so let's go into how much should I do, right? if you're considering this. So here's a I would say an analysis or a way that we look at it. A lot of times is we'll review your tax return and someone's like, well, I want to do a conversion. I'm okay with paying some tax. How much should I do? Right? And we start looking through. So what we'll do a lot of times is look at, the tax brackets. We'll compare your tax return, make sure it's similar to what your income was for this year. And we'll kind of go through and be like, well, if we've got some buffer before we get to the next tax, tax rate the next bump up and say we've got $20,000. Hey, we can do $20,000 more before we kick ourselves in the 24% tax bracket. We'll try to fill that up so we know, hey, we're not jumping into the next tax rate or anything there on whatever dollars we convert. But sometimes it's just a matter of how much are you okay with paying.
And I'm glad you brought this up earlier. You can withhold it in the account. We have clients that do that because then they're not writing the check. Some people prefer it the other way, but there's options. And it's again, just being able to be like, hey, yeah, I got to pay a little off the account. It's going to go down, but long term.
Or if you're, here's another thing, if you're a self-employed individual or your income fluctuates year to year, you have some years where you're like, hey, we bought some assets, so we have a lot more maybe offset of depreciation, maybe showed a loss in a business or something. If you're at a, you were in a, effective or an average tax rate of 20% last year, and you're like, well, I'm going to be down close to 10. You might speed up or do a couple years worth just knowing, hey, I'm paying much less this year on the conversion. So that's something to think about, especially if you have, a variable income.
This podcast is produced by Spin Market and Digital. Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market. Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarket.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarket.com. That's digitalagent@spinmarket.com or 515-302-8026. Or visit our website at www.spinmarket.com.
Let's do a little dollars and cents.
Dollar bills, y'all.
That was good, Peter.
All right, for today's dollars and cents segment, we're going to talk about Tuesday, December 2nd is the National Day of Giving, right?
Aww.
This is always little clap, applause. This is always after Black Friday and Cyber Monday.
After everyone spends all their money.
Yeah, everyone spends money, but you'll see a lot of people on TV, talking, I know this comes out after today, but talking about this, but I thought this was really, really cool, really relevant. Michael Dell and Susan Dell, who their foundation, who Michael Dell has created Dell Computers.
He's doing well.
Yeah. He's, one of the, 50 richest people in the world. They committed today $6.25 billion to fund the investment accounts for millions of children. And this is piggybacked on the seed money for what's going to be labeled the Trump accounts, which came from the last bill that was passed. But I thought this was really awesome, tied to the National Day of Giving. They're pledging $250 per child under age 10 in certain zip codes, or zip codes that are under that have a median income under 150,000. And again, really what their thought was, they wanted to be the seed money. There's going to be some additional legislation, different rules that comes out on these Trump accounts to define things. But I thought that was so awesome. They're really
they're going to help fund the accounts.
Yep. They're going to. Now the Trump accounts are a little bit. The article that I read and went through, it's for under age 10, but the Trump accounts are not that way. They're going to be
certain
from you have to be born between January 1st, 2025 to December 31st, 2028. So that's anyone that's in that age range come July 4th of this coming year of 2026, or in July. I don't know if it's exactly on the 4th, but you're going to actually, those accounts are going to be open, seeded with $1,000 from the U.S. Treasury. And then Michael Dell there'll be $250. Yeah. So I'm not sure, there was a little bit of a discrepancy because he said under age 10, and that's not the case for all the Trump accounts, but
it is interesting. So what would be the math on someone on the Dell account? Like if they give that, just, you knew I was going to ask that. I just want people to understand.
Let's use the kids accounts just to talk, because I could do that, pretty easily.
Yeah.
And really what the rule, or what it states and what's out there so far for us to find, it's going to get $1,000 initially put into the accounts, into the child's name. It's going to look like what's called a custodial IRA in our world, where there's going to be a custodian or a manager, which is going to be a guardian.
Yep.
And it's going to be required to have, U.S. based either index fund like the S&P 500 or a mutual fund that tracks the index. It sounds like that's still some stuff out there, where some of the rules are yet to come. And then it's going to allow contributions from individuals outside. So that there will be seed money of $1,000, and Michael Dell, I don't know if it's 1,000 plus his 250 or whatever it is, but that's what
More to come on that.
It's what this all tied to, but then allows, $5,000 annual contribution per child. And if you look at, some of the different math, we went through. So if you just do the one-time 1,000, never do anything else by age 18, the from the report that I was looking at, this was a white paper put out by the White House in the press release. It would have around $5,800 in it. So $1,000 child have when they reach 18, and then at that time they have the ability. It will if they don't do anything with it, it will convert to what's called a traditional IRA in their name, and it's a long-term retirement account. But if you do contributions, say some $1,000, $5,000 a year goes in for 18 years. There'd be an estimated $300,000 in there.
What I think is cool, and you said it earlier, the Dell helping all that, the certain level of income, the exposure to these people that they would get to investing that might not have that early exposure to the power of investing.
I think when they look at what will be, because what we talk about historical returns all the time, right? Yes. So if you're someone that's 18, 19, 20 years old, you get this account and say it's got $300,000 in it. And you're like, you look at this and you're like, oh my gosh.
Yes.
That's the power of just
understand
buying
the
and
system.
holding. And you're like, I look at the wealth that was created there, and there was $5,000 a year and $1,000 originally put in. And I, multiplied my number, my money by this point. Very powerful learning.
That's what I was just
and it's say. Restrictive. I know there's no distributions until 18 or later.
Because I feel like, even as I put myself as a child, I'm like, okay, people have money are the people that just make a lot of income. And then you get older and you learn the power of investing, but you truly learn the power of investing when you do it yourself and you see the growth.
Yeah, I think it's a great idea. There's been a few people that have been very in the investing world, very vocal about this. So,
because everyone always says, I wish I would have started. I wish I would have known. I wish I would have been taught.
I think it's going to be very powerful and something hopefully that continues on.
Well, even outsiders looking in could see the data from the accounts.
I'm hoping it's successful and gets enough positive feedback that even kids after, say they get 2028, those kids, the ones that are born, it'd suck. You're born in 2029, you don't get this account, right?
It's kind of like the athletes who didn't get NIL money, and then like a year later they got. It's like, dang, you really missed out.
Completely the same, but
but this is your plan, your story. So if you're gonna be butthurt, go do your own investing. You can do that every day, any day. Like, this is great. Don't have a pity party if you're not included. Just go do your own investing.
And National Day of Giving, consider giving, finding, I
was just going to say, go ahead.
A lot of organizations, especially coming up to year end, a lot of organizations that need help, need funds, or different charities that someone's involved in, but consider giving a gift. And
we were fortunate at our office. We partnered earlier this year with Cancer Connection out of Des Moines, Iowa, that supports kids struggling with cancer. And we did a Christmas partnership and helped out some gifts. So it always makes you feel good. Like that, everybody wants, but I'm telling you, there's nothing more fulfilling than helping out in this time of the year.
And don't forget, it doesn't always have to be a monetary gift, right? It can be a gift of time, maybe your expertise, whatever
Smile.
It might be. Yep.
Yeah. So, all right, let's get back into it. That was good. That was good. You were geeked out about that one.
I saw that this morning. I was like, that's a good way to tie that into today.
All right, more year-end strategies. So we're not going to go too much on this because we just went all off on Roth money.
Yeah. We're talking about Roth 401k, right? We were really talking about the Roth IRA and Roth conversions in the previous one.
So if you expect, again, future tax brackets to be higher, which, again, how do you feel about the government? That's on you, but personally, should you be doing Roth contributions or doing pre-tax? And I would say, if you go back to our last episode, we talked about this a lot. Good time to evaluate.
Yeah, and we're again relating this back to a year-end checklist. If you've not made any changes to your 401k contributions, you're like, oh, I've been doing all pre-tax, but maybe I should consider Roth. Mm-hmm. Great time to start, doing an evaluation on, hey, maybe I'm not making that much,
but I actually pay in taxes?
Yeah, you can do that analysis. Hey, I made $90,000 this year. I'm going to make $95,000. What's the difference if I go from pre-tax to Roth? Just go through. You probably find some calculator or use some AI tool to tell you, hey, what's the taxation? It's how much more will I pay in taxes next year by making this change?
We talk a lot too about farmers, business owners, all the things. Everyone included. Everyone wants a little deduction now. It's nice now, right? It's like the same concept. I just want to get back to this. Like, Roth money is like, yes, it sucks now for some people, but again, we're thinking of future RMD pressure. We're thinking of future tax brackets. This is all like delayed gratification. And yes, like, it's really nice to have a lower income sometimes now. But again, if you'd rather take it up now, that's fine. But this is just a great strategy to look at.
And I do think it's easier to do it over the course of the year.
Yes.
Versus like when you do a conversion, it's kind of a lump sum hit,
Yes.
right? So if you're just, hey, maybe I'm not going to do a conversion, but I want to start saving more in Roth. Let's just flip some. It doesn't have to be all, but some of your contribution to Roth, and then it's it's more of a gradual, so you don't feel maybe as big a hit on the tax side.
We talked about this. I just think Roth will become, and they could be changes to Roth in 20 years. Maybe they make change, but for now, it's a very powerful bucket. So we, again, have a lot of clients that wish they would have been more. Peter was just telling us someone came in to him, taught him about Roth. Like it was very relevant, I feel like, for our generation to learn about it. So, all right, another one, use of annuities and life insurance. How could that help out, Cole Jaski?
Yeah, so this is, I would say where annuities come into play. I'm not going to talk so much on life insurance. There's quite a few different tax strategies, things you go in there. It's not something that we do a ton of, but there are times where it does make sense, but there's not a lot of year-end stuff that really is relevant to that. But on the annuity side, this is more relevant to people that maybe do not have a 401k through work, and you want to save on a deferred basis, or where, hey, you don't want to pay, maybe you're in a you're self-employed, super high income tax bracket, and you're like, I'd like to save, but I don't want to pay the taxes every year when I make the dollars. And that's where, let's use a non-qualified account and, say a brokerage account that you buy and sell stocks in. Anytime you buy and sell and there's a transaction, there's a gain or loss in a non-qualified, you have to realize in that tax year. So what annuities allow you to do, they allow you to defer the gains. Now you can't buy stocks in annuities, but you can there's ones that allow you to buy indexes, allow you to buy mutual funds.
They come with a lot of features.
Yeah, different types. And again, not relevant for everyone, but there are times where that deferred, if you might say, hey, I'm going to be in the super high tax bracket for the next 5 years, and then I know I'm going to have a liquidity event, transition, I'm selling a business, and then it's going to go from 40% to 15. You might say, yeah, let's defer these out 5 years, or compound the gains, deferred, no taxation on them, and then I'll worry about the taxes when my tax rate drops much, much lower. And that's a lot of times, sometimes when annuities come into play, not always the case, but that's where I've seen them used.
All right, another good one to look at right now is qualified charitable distributions. Go into that, and then kind of get you all giddy again because
the National Day of Giving, right? So QCDs, short in our world, but qualified charitable distributions. They're very, very powerful. These are for
especially 70 and older.
Yep. If you're 70 and older, or generally people that are 70 or older and you've had pre-tax, you're going to be RMD required to take
RMDs
distributions.
are coming for you.
Yeah, but if you're 72, going to be 73 next year, you're kind of doing some planning. QCDs might be a strategy, and this is allows you basically to gift directly from your retirement account, to a qualified charity or organization that qualifies for, tax deductibility purposes, and you don't have to claim. It satisfies that distribution amount.
Yes.
The IRS might make, say, hey, you've got to take $50,000 out of this account.
And pay taxes, but instead.
Yep. And let's use that as an example. Let's use 50,000. Say I'm someone, I have, $1.5 million in my IRA. I'm 74 years old, and the IRS says I got to take $50,000 in
all this year
required minimum distributions. And I might say, well, I give to the church $25,000 a year anyways. I'm just going to have, my broker dealer or whoever holds my IRA, I'm going to have you write a check directly as a QCD or qualified charitable distribution.
The money doesn't even come to go straight.
It goes right to the organization, paid. You satisfy $25,000, and then you just have to take the other $25,000 out and pay and claim it. Now, you no longer have to claim that $25,000 as income, and the IRS satisfies that dollar amount. So very, very powerful. So if you're
lowers your income for Medicare, Social Security, taxation, all these things.
If you're someone that has an RMD, a required minimum distribution, and you're gifting to charities, it should definitely be
your account.
Yes, it should definitely be an analysis you should look at. And if you're not currently doing this, I would strongly consider it, because it's not that hard to do. And
most people are giving, right? They're just either throwing it in through check or cash. So basically, instead of it coming from the account, it's coming to them, and then they're putting it in anyway. So you might as well get the deduction.
And we have people, and with our setup, that they actually have a checkbook tied to their IRA account. We raise the cash. If you're someone that likes to gift once a month, and you were like, hey, I go to church, I put in the offering plate, that's fine. You can do that.
But it comes out of your account.
Yeah, it comes right out of your IRA, paid directly to the institution, and that qualifies from the IRS standpoint as a qualified charitable distribution.
And we'll get into this later too, because we're going to get into RMDs, but inherited RMDs and stuff like that. We have clients that, again, it doesn't even come through their checkbook. We have it set up so a check gets automatically sent to the charity of their donation, and then they don't have to deal with it. So awesome. So yeah, it's a great way if you have an IRA account and you're already giving or you want to start giving, because giving is the season and the reason, right? Look into this option. Cole didn't like that. All right. Annual gift exclusion. Go ahead, Cole, because I got it.
Yeah. So this is, again, what this is, or the annual gift exclusion is, the IRS allows you to gift to, in theory, anyone up to $19,000 right now is what it currently is, and set to go up next year per person. Without having to do anything funky on your tax return. They don't have to claim anything. And that's up to $38,000. Say you're a husband and wife, you could gift up to $38,000 to your children, right? With no tax implications.
Again, another good strategy.
Yeah. So common time, again, got to be done by the end of the year. Yep. So if you want to do this, so, and you can always gift them more than that, but there's extra tax forms. There's different things that come along with that. And it goes against what's called your lifetime gift exclusion. Not complex, but it's basically the amount that you can give away in your lifetime. Pretty high. So yeah, it's like $13 million per, like $26 million per couple or something like that. But it starts reducing that dollar amount if you gift more than that. So if you give $200,000 in a year, and then there'd have to be some tax forms filed and all that. So if you just want to make it easy,
clean, tax-free.
And we see this, someone that's, maybe has a rather large estate, or their values are rather high, and they're like, hey, I want to start making sure.
We're not saying hiding money. We're saying gifting money.
I could live long. My estate could go, above that very large, that $27 million amount or whatever. This might be a strategy you start to look at on an annual basis, or you're just like, hey, I know I have more money than I need. I would like to start giving it to my children.
So they can enjoy it now. Yeah, I love this, and I want to bring this up, and we won't obviously. You have a client who does this, but they have to sit with you. This is also a good way, if you are going to give money, go into that. You have a client, basically, Cole has a client, he gifts the children money, but they have to sit with Cole and go over it and the options. And it's a way, basically, he's tunneling them into investing.
Yeah, I mean, it's a good conduit for us, right? Yeah. But it's like, one of the parameters around the gift is that they get to make their own decisions, but they have to at least have a conversation on the different options. Here's what you were gifted.
Which is a real gift, because there's no chains to it.
So it's not just like, hey, I got $19,000 deposited in my bank account. I can do whatever I want with it. Generally, there's an asset. So this individual gives a stock or a mutual fund, whatever it might be, depending on the year. And then one of the beneficiaries of that gift, they have to decide, do I want to keep it, sell it? Do I want to put it in my bank? Do I want to convert it into my long-term portfolio, right? They have to have that conversation. And we see a lot of that with appreciated securities, or where someone gives stock. So say, for example, you're giving it to, I'm in a high tax bracket, I have a very low basis, or I have a big gain in Apple stock or whatever it might be. I can gift over to, this grandchild that's not in any tax bracket, and they can realize the capital gain, a lot easier than I can, or they can just keep the stock on a deferred basis.
Yeah. It's just a good little gift, tie in there. So, all right. Any other strategies to look at year-end, Cole?
Yeah, I would say, just wrapping up, if you're someone that has non-qualified assets, so non-retirement account assets that are invested, so you
just invest in money.
You have mutual funds, stocks, ETFs, bonds, whatever it might be.
Gold.
Definitely look. Right now is the time. Gold. Right now, you should be looking at what's called tax loss harvesting, and also the tax efficiency of your investments, right? So, because we're going to come here the next 3 weeks, we're going to see it's going to be capital gains distribution season. That's where if you own a mutual fund in a non-qualified account, you're going to get dollars. Basically, they bought and sold all year, and they might have a tax gain, and then they're kicking that off to the shareholders, something you cannot control, but you do have to claim you have to claim that on your income tax return. So, this is that time to start looking at that, especially if you're planning for next year of maybe what I'm investing in, or if you bought a couple stocks that are maybe losers. Hopefully there wasn't too many losers. It was a pretty good year in the equity market so far. But if you do,
it's time to look at that.
You might be able to offset, hey, I made a lot of money in this stock, I lost some in this. You can offset and take some gains, take some losses, and you don't really, you don't net anything or lose anything on the tax side there. So next 30 days, or what do we got, 29 days left?
Isn't that crazy?
Start thinking about those things, and talk to your advisors, or if you're doing it on your own, strongly consider going through your portfolio and looking and seeing if there's any other tax transactions that I can make before the end of the year.
Yeah, and I would say the year end, we just don't want you scrambling. We want you to take control of the will, look at the RMDs, look at your Roth strategy, your charitable giving, your gifting, all the things we just talked about, and just look at.
Don't call us December 28th and try to do a Roth conversion.
This is my favorite. This is like December 30th.
We do this every year. We always talk about this every year on the podcast.
I'm like, hey, did I take my RMD? I'm like, wow, no time like the last, because it takes time to process. It's not like you can just, take an RMD. They have to sell out of whatever you're in, you guys.
I tell everyone that has an RMD, the last day I want to hear from you is December 15th.
Yeah.
I do not want any business for
Cole's going
required
to get on this train with me, but I heard an advisor say this. Everything needs to be done by December 15th so we can re-strategize on 2026 and take time off. That's my that's where I'm going.
I've set that hard deadline. I always say that you got a distribution. It needs to be done by the 15th because if not,
it might not process in time.
You're going to go to Bailey as your primary advisor. So
odd thing. Yeah. Well, there is penalties if you don't get your RMD, so that's why it's important. If you took anything away from this podcast episode, I would say definitely just be intentional. Be intentional of what you're putting your money into, and can you save some taxes? Obviously, everyone wants to do that. And what do you think taxes are going to be in the future? These are just tips that make such a big difference down the road that you need to look at every year end.
It's part of our daily conversations that we're having with people.
All right. So again, we're wrapping up the year. I want to add this. We want your feedback on the podcast. If you have questions you want us to answer, if you have topics you want to hear, we're gonna kind of keep evolving and growing the podcast. And again, I know you love hearing all of our sports thought and us geek. No, I'm just kidding. I know you guys, but we're taking feedback. So we just want to get more into the financial stuff, but we really want to know what you guys want to hear. And again, this is a great time to evaluate your own financial situation. Don't wait till January. Start now. Look at these strategies, definitely now. But also the last couple episodes really will set you up for a successful 2026 year. As 4-time Super Bowl champion would say, Joe Montana, winners do what losers don't want to do.
You've been listening to How to Money with Cole and Cole, the podcast of Full Swing Financial Planning. To learn more, visit their website at www.fullswingfinancial.com and follow them on Facebook and LinkedIn.
For now, I'm Cole.
I'm Bailey.
And I'm Cole.
And we'll see you on the greens. 4!
Security and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.